Okay, so the question I get asked more than any other is some version of this. Should I use Binance or Uniswap, Coinbase or a decentralized exchanges? Where should I actually be trading? And almost every video out there gives you a tribal answer. The DeFi crowd will tell you centralized exchanges are evil. The CEX crowd will tell you that DEXs are too complicated for normal people. Both of them are wrong. Here's the truth. In 2026, almost every serious crypto person I know uses both. They use centralized exchanges for some things, decentralized exchanges for other things, and they know exactly when to switch between them. Today, I'm gonna show you what they know. By the end of this video, you will have a clear framework. You will know which platform to use for which kind of trade, and you will stop leaving money on the table by picking the wrong tool for the job. Real quick, in case anyone's new, CEX or CEX stands for Centralized Exchange. Binance, Coinbase, Kraken, Bybit, all of those, they work like a stockbroker. You sign up, you do KYC, you deposit money, the exchange holds your crypto, and you trade through their interface. They take custody for your funds. That's the key part. DEX is a decentralized exchange. Uniswap, PancakeSwap, Hyperliquid, Jupiter, and Solana, a whole bunch of others. You connect your own wallet. You sign trades from your wallet. Your crypto never leaves your control. The exchange itself is a bunch of smart contracts running on a blockchain. No company holding your funds. And this is very important. The single difference, custody versus self-custody, is what drives almost every pro and con you're about to hear. First, fiat on ramps. You want to take dollars or euros or dirhams from your bank account and turn them into crypto? You basically have to use a centralized exchange to do that. Here are some weird workarounds, but for 99% of people, the answer is centralized exchanges with a verified bank account. Second, liquidity. For the biggest trades, if you are trading a few $100s, this doesn't matter. But if you are moving 50,000 or 100,000 at a time, the price impact on a DEX can be brutal. CEXs like Binance have order books so deep you can move millions without really moving the price that matters. Third, advanced products, derivatives, margin trading, futures, lending, staking, copy trading. Most of this stuff lives on centralized exchanges. Yes, you can find on-chain alternatives for almost all of it now, but the user experience is just smoother on the centralized side for most of this. Fourth, customer support. If something goes wrong on a centralized exchange, a deposit doesn't show up, your account gets locked. Whatever, there's a support team you can email and talk to them. But on DEXs, you cannot do something like that because there is no any support team and you have to be careful. Fifth, regulation. This sounds boring, but it's important. Centralized exchanges in most countries are regulated, which means there's a legal resource if things go really badly. For most people, especially when you are starting out, that's a real safety net. Now, the other side, where DEXs actually beats centralized exchanges. First, self-custody. This is the big one. On centralized exchanges, your crypto is technically owned by the exchange. They have the keys. You have an IOU. On a DEX, you have the keys. Your crypto is in your wallet the whole time. If the platform disappears tomorrow, your funds are still safe in your wallet. Second, access to new tokens. The vast majority of new tokens launch on DEXs first, sometimes months before they make it into Binance or Coinbase. If you want to be early to anything, you have to go on-chain period. Third, no KYC. On a centralized exchange, you upload your passport, your selfie, sometimes proof of address. On a DEX, you connect a wallet, that's it. Now, important caveat, depending on where you live, the legal status of trading without KYC varies, so do your own research on this, but the option exists. Fourth, transparency. Every trade on DEX is on-chain. You can see the order book, the liquidity, the fees, all of it. On a centralized exchange, you are trusting the exchange to honestly tell you what's happening with your money. After the events of the last few years, that trust isn't there. Fifth, And this is new in 2026. Competitive execution. Modern DEXs on layer 2 networks plus intent-based platforms like Cow Protocol or Uniswap X are actually starting to match or beat centralized exchange execution quality for lots of trades. The old gap is closing fast. I have to say this part because nobody else will. November 2022. FTX, at the time, the second biggest crypto exchange in the world, founder is on the cover of every magazine, donating to politicians, sponsoring stadiums. The whole thing looks bulletproof. In the span of about 72 hours, the entire exchange collapses. Customer funds frozen, withdrawals halted, billions of dollars gone. The founder ends up in prison. Hundreds of thousands of regular users lose access to their crypto. Some of them never get it back. And here's what was interesting. Through that entire weekend, while FTX was burning down, the DEXs kept working perfectly. Uniswap, Curve, all of them. People who had funds in their own wallets, completely unaffected. People who had funds on FTX, destroyed. That's a new lesson. Now your keys, not your coins. It's a meme, but it's a meme because it's true. Anything you keep on a centralized exchange is at the mercy of that centralized exchange continuing to exist, to continuing to behave honestly. Most of the time they do, sometimes they don't, and when they don't, the losses are usually total. Doesn't mean don't use centralized exchanges. Means don't store life-changing amounts of your money on them. Use them as a workbench, not a vault. Quick update on sometimes that's been happening over the last couple of years. The line between centralized exchanges and decentralized exchanges is getting really blurry. OKX has a DEX built directly into their app. You can trade self-custodial on-chain assets without leaving the OKX interface. Coinbase launched their own layer 2 base that hosts a bunch of DEX activity. Binance has a Web3 wallet integrated into their main app. Even Hyperliquid, which started as a pure DEX, feels almost like a centralized exchange when you use it. What this means for you is that the choice isn't always clean anymore. Sometimes you can get the best of both worlds in a single interface. The thing to pay attention to is when you click that button, are you actually trading on-chain with your own keys, or are you using their custodial layer? The interface might look the same. The risk profile is different. Okay, here's the framework. The thing that takes all of this and make it actually useful, I think about it as 4 questions. Question 1, am I buying with fiat or am I already in crypto? If I'm coming from a bank account, that's a centralized exchange. If I'm already holding crypto and just swapping, either works. Question 2, how long I holding what I'm buying? If it's a quick trade in and out in days, staying on centralized exchange is fine. If I'm holding for weeks, months, years, get it off the centralized exchange and into your own wallet. Question 3, is the token I want available on a major centralized exchange? For Bitcoin, Ethereum, the top 50 coins, yes, just use the centralized exchange. For anything smaller, anything new, anything weird, DEX, on-chain, you are doing here anyway. Question 4, how big is the trade? Small to medium. Anywhere is fine. Very large, favor the centralized exchange with the deepest liquidity for that pay. Or use a DEX aggregator that routes across multiple pools. Run any trade through those 4 questions and you will know what to do. The answer is ready the same twice in a row. And that's the point. You are using the right tool for the right job. 1, treating your centralized exchange account as your wallet. Long-term holding sits on the exchange. Then the exchange has issues or the regulator freezes accounts or you lose access. Always move long-term holdings to your own wallet. 2, going on-chain to chase the hype without understanding gas fees, slippage, MEV, all the on-chain gotchas. A $20 trade on Ethereum mainnet can cost you another $20 in gas if you're not careful. Use layer 2s, use cheap chains, be deliberate. 3. Using the wrong DEX for the asset. Trying to swap a Solana token on Uniswap or a base token on PancakeSwap. There are different ecosystems and the liquidity lives where the chain lives. Find out which DEX has the actual liquidity for what you are trading before you start. That's it. Centralized exchange versus DEX. The honest version, they are tools. Use both. Know when to pick which. Next week, we are switching modes completely. We've spent this first 6 videos on tools and basics. Now we go strategy, starting with the single most important strategy in crypto for regular people, dollar cost averaging. It's boring, it works, and almost nobody actually does it right. See you there. Bye bye guys.